Welcome to today's deep dive. We are jumping right into Benjamin Graham's foundational investing principles today.
Yeah, the real classic stuff.
Right. And our mission for this deep dive is to basically permanently rewire how you react to stock market volatility. So to start, I want you to imagine you have this deeply erratic business partner.
Oh, this is a great way to look at it.
Yeah, so every single day he knocks on your door, or, well, I guess today he'd be blowing up your phone with alerts, right? And some days he is just totally euphoric. He's convinced your shared business is flawless and demands an absolute fortune for his shares.
Right. He thinks nothing can go wrong.
Exactly. But then other days he's in absolute despair. He's completely convinced the economy is doomed, and he just begs to sell you his stake for pennies.
Which, I mean, most people would just block that guy's number immediately.
Right. Please leave me alone.
Exactly. But Benjamin Graham actually created this character, famously known as Mr. Market, to illustrate this core truth, which is that you actually want to answer his calls.
Because he gives you opportunities.
Yes. Graham wanted us to see that in the short term, the market just isn't a rational pricing engine at all. It's an emotional voting machine.
Right. The classic Graham concept. A voting machine in the short run, but a weighing machine in the long run.
Precisely.
But let's look at the actual mechanics of that voting machine today. Because it's not just, guys in suits getting emotional on a trading floor anymore.
Oh, absolutely not. It's way more complex now.
Yeah. We're talking about algorithmic cascades, social media echo chambers, and just massive institutional FOMO all kind of feeding into each other.
It really is this massive feedback loop. Like when a stock starts trending, index funds and these momentum algorithms are mechanically forced to buy it.
Which just drives the price even further away from reality.
Exactly. It completely detaches from its actual gravity. But then eventually the weighing machine kicks in. Reality asserts itself, and the market perfectly weighs the business's actual underlying cash flow and assets.
So conceptually, we should treat Mr. Market's daily ticker tape like browsing a chaotic thrift store.
I like that. A thrift store.
Right. We browse the aisles looking at the price tags purely for information, but we're never actually forced to buy anything.
That's the perfect mindset. You're just observing.
But I do have to push back here a little bit. I mean, it's really easy to sit here and say, just ignore the mood swings.
Sure.
But when Mr. Market slashed prices by 50% during the 2008 financial crisis, real banks were actually failing. The thrift store was literally on fire.
It definitely felt like it.
So how are you actually supposed to confidently separate a temporary panic from a permanent economic shift?
Well, that is the ultimate psychological friction of value investing right there. I mean, since our listeners already understand the math behind intrinsic value, modeling out discounted cash flows, assessing hard assets, the challenge isn't the calculation.
And the math is the easy part.
Exactly. The hard part is having the discipline to trust your own models when the entire world is screaming that you're wrong.
Which they were in 2008.
Oh, absolutely. In 2008, Mr. Market was terrified due to a massive liquidity crunch. You had institutions that were literally forced to liquidate everything.
Just to get cash.
Right. They were dumping shares of highly profitable, structurally sound companies at 70% discounts just to raise cash to survive.
So it was just forced irrationality.
Exactly.
Which is really the exact inverse of the 1999 dot-com bubble.
Oh, totally.
Because there, the forced irrationality was to the upside. Asset managers essentially had to buy these absurdly overvalued websites with zero revenue.
Just to keep up with the benchmark indices.
Right. Or they'd risk losing their jobs for underperforming.
And that actually brings us to the ultimate mindset shift. This is really the core of it. How you can actually use market panic to make bargain purchases.
It's a goal.
Right. You have to recognize when the voting machine has broken down due to these mechanical pressures. I mean, while the rest of the world was panic selling in 2008, Warren Buffett famously published his op-ed declaring he was buying American stocks.
Right in the middle of the crash.
Exactly. And he wasn't ignoring the macroeconomic crisis. He just recognized that the intrinsic value of these underlying businesses hadn't dropped by 70%, even if the stock price had.
He was exploiting Mr. Market's liquidity panic.
He absolutely was.
He was basically taking advantage of the clearance sale.
Yeah.
And I think once you permanently sever that link in your brain between the daily price tag and the actual intrinsic value, a market crash completely ceases to be a disaster.
It really does. It becomes a massive buying opportunity. You step out of the herd.
You use the panic rather than letting the panic use you.
Exactly.
So, the next time that erratic business partner comes banging on your door, waving a red ink financial paper, just take a breath.
Check your model.
Check your models.
Yeah.
And we will leave you with this to ponder today. If the market is a hyper-emotional voting machine in the short run and a ruthless weighing machine in the long run, which incredibly popular stocks dominating the news right now are merely winning a temporary popularity contest, just waiting to be weighed tomorrow.